The S&P 500 has fallen around 10% with all the talk around Trump's tariffs, with many stocks seeing even larger declines. Tesla, for example, is down 33% in the same period and 50% from its all-time high. Now is an important time to learn how to manage your portfolio, and we'll focus on practical strategies to help you do just that, something not many are discussing right now. Now, at the time of this recording, the S&P 500 had actually rebounded around 2.5%, which raises the question, is this well-publicized crash that's all over our media channels already over, or is this just a temporary climb before further weakness? Right now, there's absolutely no escaping the talk of Trump's tariffs and trade wars. 1 minute it's on, the next minute it's off. This is the current flavor of the month in our media channels and amongst influencers, spreading fear and uncertainty, which is ultimately what gets all the clicks. Then there's the constant comparison to the 1929 crash when the indices declined by around 90%, also brought about by a trade war. Throw in the word recession for good measure and you have a melting pot of fear and confusion. Not the media putting the heebie-jeebies in you, surely not. So let's bring some calm and logic to what's happening, and more importantly, how we can protect our portfolio and then position ourselves to profit from the next boom phase in the market. Okay, let's start by studying the S&P 500 in a little detail. The last true bear market was during the financial meltdown between 2007 and 2009, when the S&P 500 declined by almost 60%. Since the low of 2009, the S&P 500 has climbed over 810% to the current all-time high before this recent 10% correction around tariffs. It's a tiny correction on the grand scheme of things, which of course has the potential to continue to decline. But for now, it's just that, a small correction, and certainly not a crash. Studying the bigger picture always helps to keep perspective and distinguishes between correction periods and actual market crashes. The 35% COVID-19 flash crash got absorbed into this trend. The 28% correction in 2022 also got absorbed into this long-term trend. The talk of failing banks at the start of 2023 did absolutely nothing to wobble the market. In fact, it rallied by around 70% to the all-time high before this recent correction. There's every chance that this current media hot topic of tariffs will also get absorbed into this bull trend. The question is, how far could the stock market drop before the recovery comes in? This is a fair question where the answer is somewhat unknown, which is what makes investors so nervous. But here's the thing, we can look to the past for clues, as patterns do repeat. Now, in general, influencers tend to fall into two camps. They either claim to know precisely what's going to happen next, or they say that nobody knows what's going to happen next. They are talking in certainties, which goes against the very fabric of investing. As investors, we think in terms of probabilities and not fall into either of those two camps I just mentioned. Those who claim that they can see the future are definitely a bunch of fraudsters. I know you know this, but I'm saying it to reiterate it because people can be convincing. And when you act desperate, there's someone out there shameless enough to sell you what you want. So just to be clear, no one can see the future, right? Okay, good. Now, those who say that no one knows what's going to happen next are right to a certain extent, but they're missing a very important piece of the puzzle. This shows how they often don't know much beyond the very basics, which ultimately amounts to nothing more than dollar cost averaging, investing in a tracker fund and ETFs, and setting up a direct debit. And then ultimately regurgitating that outdated expression that it's not timing the market, it's time in the market. Look, this is fine to a certain extent. It's a great place to start, but you don't want to stick to just this. You often get nothing more than the market average when you can do so much better investing in the right stocks. As private investors, we've evolved and have learned to just be better and more complete investors with the tech available today. That is, of course, if you allow yourself to, because there is a learning phase. It doesn't happen overnight. These finfluencers, who are ultimately positioned as experts, are missing the fact that we can study the trend structure of the S&P 500 and build clues to what is likely to happen next. This is a proven approach that has topped performance tables for decades, where we use technical analysis, which is just a flashy word for charts, to identify future price action movement. If it has happened in the past, it is very likely to happen in the future. Likely, not guaranteed. I can't emphasize enough that patterns repeat. Looking at the S&P 500 on the monthly time frame, which is where we get a very clear sense of the DNA of the index's price movement and trend structure, shows that the previous two corrections in the trend have both been around 10%, which is similar to the current correction. So the trend structure in play right now has been uniform since 2022. And so if the bulls start coming in now and pushing the market up, then the index is continuing to follow this pattern. However, if the trend structure is broken, the bears continue to gather momentum, then the 5,000 round number is the likely next target. Price gravitates to psychological round numbers. The 76% bull run since 2022 climbed all the way to the 6,000 round number, which has acted as a resistance zone and forced the market down. Let me put this another way for you. If you didn't have a TV or social media and had no idea Trump had been re-elected, which has led to the potential of trade wars due to Trump's tariffs and thus an impending recession, all you would see is a correction at the 6,000 round number, which is perfectly normal price action behavior. You would think nothing of this correction, as you would expect at the 6,000 round number. And this is precisely what we see here at Sublime Trading, because for us, technicals are superior to fundamentals. Now, if the 5,000 round number is broken, then the weekly 200 simple moving average will be the next key level of support. This is major support, and one that hasn't been broken since 2008. Since 2010, when the S&P 500 moved back above the weekly 200 simple moving average, each time it has sporadically pulled back to touch the weekly 200 simple moving average after a strong bull run, it has bounced off this level and been the catalyst for the next boom phase in the market. If the weekly 200 simple moving average is broken, then we enter true bear market territory, as we did in 2000 and in 2008. But not all is lost. Far from it, in fact. We simply position ourselves to short the market and profit on the way down. So even if we do enter bear market territory, there's plenty of money to be made. You just have to learn how to execute a strategy that identifies and shorts a bear market. Online brokers today allow us to take short positions. So if you consider yourself an investor, it would be criminal not to know how to short a market and take advantage of what modern day brokers allow us to do. It all goes back to being calm and methodical and understanding how to approach the market as a whole, all clearly written down in your investing plan, and not buying into the constant fear mongering. Okay, so when it comes to managing the stocks in your portfolio, here's how we do it. When the indices declining, stocks are also declining, but not all at the same speed. Some are holding very well, while others are weakening at quite a pace. Let's look at McKesson and Cencora, for example, which are healthcare stocks. These are both trading near their all-time highs. So if they're in your portfolio like they are in ours, then you simply need to hold these stocks. And when they break out and lead the indices, we'll look to buy more, also known as compounding, which we only do with winning positions. However, stocks like Marriott and Hilton, which are in the consumer staples sector, have declined significantly from their all-time highs compared to the S&P 500. So these are stocks you may want to consider exiting from. A key part of our approach is to look at the major sectors, see how they're performing, and then look at how the strongest stocks in those sectors are performing. Now, as the indices are weighted, when big tech struggles, the indices struggle. But stocks in the healthcare sector, for example, could still be performing and holding very well, as McKesson and Cencora are doing right now. When a decline in the stock market happens, it's certainly a time to objectively rebalance the portfolio. This is not a time to sell everything, as that's based on fear and emotions. When the ship is sinking, you throw off the dead weight. Rebalancing a portfolio in a decline is absolutely no different. Remember, a good investor has all of these rules clearly laid out in an investing plan to which you must refer daily. This removes all the guesswork and hesitation and brings a mechanical, objective approach, which is an absolute must. This is really the meat on the bones when it comes to investor psychology, which we hear a lot about. It just means having a robust and proven strategy and knowing how to execute it consistently well through all market cycles. History proves that the market always recovers. This could be another buy the dip moment, but there is an element of timing to it. It's always good practice to wait for the market to show it has found support first and is moving up before buying in. You must avoid catching a falling knife at all costs. As investors, we must always focus on long-term growth trends and avoid short-term panic. Always let the chart dictate your investment decisions, not the media and misinformed opinions. Okay, now let me remind you of the concept of profit and loss. Bad traders think in terms of winning versus losing. Those who seek quick wins want to take on and defeat the market, but they always find themselves on the losing side. The market is simply way too vast to be defeated. Good investors think very differently. We don't want to defeat the market. Instead, we respect the market and align with her. We think in terms of profit versus loss. We maximize profit through holding and compounding winning positions during periods of boom. We take profit, cut out of losers, and apply patience during corrections. We focus on the process and not the P&L column. When you let go of the money and focus on the process, the profit comes to you in abundance. You have to earn your stripes. What we learned was to focus on what is in our control, which for good investors is picking high probability stocks and assets, protecting your downside, and letting the money come to us. We let go of what is not in our control, which is ultimately the outcome of any single position. However, by repeating a winning strategy over many years, we make far more profit than loss. And by compounding our winners, we significantly outpace inflation and build a very healthy pot well before retirement. I stay aligned with the bull market, but remain patient during market corrections while managing my portfolio. When the next bull trend starts, I use my scanner to identify stocks outperforming the market average, helping me achieve superior returns. Watch this video to learn how to do this and pick winning stocks in just 3 seconds.